Assalamu alaikum, sabah al khair, kaif al hal? I'm Attila Shelley, and I'm a professor at Geneva Business School, and I also am active in consulting and advisory services and so on. I was educated mainly in the United States at Princeton, Stanford University, studied science, engineering, and then finance and business for many, many years, and I have 30 years experience not just in finance and financial management, but as well in corporate strategy, management, leadership, and so on. And I worked in a number of companies in various roles: asset manager, management, top-level management, middle management, and management consulting as well at Boston Consulting Group. And I've also done quite a bit of venture capital investing in the United States, in Silicon Valley. So, and I have 24 years experience at a number of universities, including Stanford, Business School Lausanne, and of course, Geneva Business School as well. What we will do today is we'll go over the major parts of financial management. Now, in general, I teach this course over 24 hours, right, in Geneva Business School. So we have to condense everything in about 10, 11 hours, which means that you should not be surprised if you don't understand everything as soon as you see it, right? Because many of the concepts are new, and the important thing is to ask questions, both in class, but definitely if you have all kinds of misunderstandings, you don't know certain words or certain concepts, just come to me during the break, okay? So for example, I'll be here after lunch, around 12:30, so anybody who have an hour to just discuss things and give you personal assistance, examples, and so on. And don't be shy to speak up and say, look, could you give us another example, or could you explain that again? Because there will be dozens and dozens, maybe even 100, 200 terms that are new for many of you. Of course, a number of you probably already have some finance experience, financial management experience. Now, one good thing about this, the study materials, is there is a glossary of terms. If you open it at page 27, a lot of the terms that we'll be discussing are there. If something is not there, just ask me, okay? So there's no problem. And another nice thing is on page 35, we have all the formulas that you will need for exercises and for the group project, but also the formulas that will be present in the final exam. So the more you practice these formulas in context, as we'll do it, of course, the better you'll be prepared for the final exam. The formulas, you don't have to remember them. They will also be on the final exam, but you need to be able to choose the right formula, right? So that's why it's very good. And then, of course, before page 31, actually before page 27, we have a lot of exercises, including the group project, which is on page 25. And before you leave today, we'll go in detail over that, because it will be a very good way to test yourself about the terms, the concepts, and so on that we've learned in class. So we'll start by simply introducing management, financial management, what it is, what do we do about it, why it's important. Then we'll have a brief introduction to the financial market environment, financial institutions, banks, investment banks, and so on. So to get a feel for what are the institutions that a financial manager in a company needs to be aware of. And we'll mostly look at it from the point of view of a financial manager inside a company. How do we deal as a financial manager inside a company with the external environment? How do we get funds? How do we invest? And so on. So we are But what you learn here, we'll have a couple of examples, will be very useful even in your personal life or family life. How to count your income, outgo, your assets, liabilities, and so on. So it will have that kind of, so we'll talk about that. Then the very important, the heart of the class today is financial statement analysis. Without this, and this is mostly accounting, but without this part of accounting, we cannot do finance, right? So we need to, some of you might know already some of these things. How many of you have taken accounting as such, ever? So very few, which means that we'll have to go step by step because it's not easy to study accounting in 3-4 hours, right? Again, accounting is a full course of 40 hours in many schools. So we'll just go over the basics that are important for you as financial managers. Tomorrow, we'll start with cash flow and financial planning. So we'll see today, we'll talk about accounting and cash. And the cash is king in finance. Profits are king in accounting, cash is king in finance. So we'll talk a lot about cash flow and financial planning, about incomes, cash flows which come in the future. How do we calculate those in terms of what do we do today? Let's say we want to invest in a project which will bring cash flows, money coming in over the next 10 years. How much should we invest? How do we invest it? And so on. And we'll finish with capital budgeting, which means how do we invest in new factories, buying land, buying new equipment, and so on, new projects, new companies. Okay? So, we'll start with global markets, and there are two terms, capital markets. So write this down, the key terms, try to write down because I'm sure many of you will have questions about those. So we'll focus a lot on capital markets and money markets. So those two terms are really important and we don't want to confuse them. Okay, so money market, capital market. We'll talk about that later. The financial statements, the 4 financial statements, we'll go over that today. You don't need to write that down. And very importantly, financial ratios, which are really important for financial managers to understand how their company is doing. Are we doing well? Are we doing badly? So those are the financial ratios. And then tomorrow, we'll go to the financial planning process, which has a lot to do, as I said, with cash flows. Cash goes in, cash comes out. That's the financial and we'll prepare the cash budget, and then we'll see how things happen in the future. We've already gone over the timeline. Great, so we'll start with the first module. And the objectives of this module are the following: to understand the interlinkages. Interlinkages, everybody knows the word interlinkages, right? Everything is connected in the real world with the financial world, right? So we need to understand the linkages in global markets, which we will start with physical markets. People buy, people sell things, services, and then interlink it to financial markets, how companies produce those, and what do they need to do to produce those. We'll also discuss some career opportunities in finance. Many of you are not in finance, but you might get excited after this course and say, well, maybe I want to study more finance because I want to become a financial guy. Who knows, right? So we need to talk about a little bit about career opportunities. Then a very important thing about which there is a controversy is the goal of the firm. If you start a company or if you already work in a company, what should we do? What is our purpose in the company? Is it to maximize shareholder wealth? Is it to please the customers? Is it to please the workers? There are all kinds of goals, and in various cultures, various goals are more or less important. So that's important. It's a cultural issue, but it's very much in the news, especially in the US and in Europe. The differences between various European countries in the goals of the firm. And obviously, in many developing markets, it becomes more and more important to understand those issues. And then we need to understand how the financial management function is connected to economics on one side and, as we said, accounting, very, very importantly. So, what is finance? Nobody has a final definition of finance or a definition which is non-controversial. But for us, we can say that finance is the science, very important, and art. It's science and art together. It's not pure numbers like physics. It's not pure art like literature. It's a combination of the two, of managing money, okay? And that's a simple explanation. It's not 100% correct because none of the explanations are 100% correct, but is okay for our purposes. Now, finance can be looked at, as we said, at a personal level, okay? And that's the easiest way for you to start understanding. What do? We are workers, or we work in a company. It doesn't mean with your hands necessarily, but you can work in a factory with your hands, you can work with your brain, you can do all kinds of things. So the first thing is we get earnings, money. How much do we spend of it? All of it? Some of it? Okay, that is finance. And you'll see this is translated to the corporate finance world or managerial finance. How much do we save out of this, right? And if we save money, how do we invest it? Do we put it in a bank? Do we put it under the mattress? Do we buy real estate? And so on. Okay, so that's all finance because it has to do with money. Now, in a business context, the same thing, but slightly more complicated, right? Because firms need to raise money from investors. Think about it throughout this course about starting a company. Let's say there are 4 partners, right? They want to start a company. 4 partners, okay? Right, so there are 4 partners, each investing $1 million, okay? Or real, whatever, okay? So $1 million. That means raising money from investors make these 4 partners are actually investors. They are putting their money in order to start a company to make more money, okay? They believe they can make more money than putting it in a bank. Now, there's another thing. Here, there is no interest, right, in Islamic finance. But in the Western world, when you put money in a bank, you get interest. And always investors say, well, if the interest I get from a bank is very high, it's fine, because it's a big bank. I don't think it's going to go bankrupt. I'm going to sleep and just get the interest. But like today, interests are very, very low from a bank, almost zero. Then it's much smarter to think of a business because you get much more money out of it, okay? And that is perfectly fine in Islamic finance as well, profit versus interest. So when we have 4 partners, each investing $1 million, how much money goes into the firm? $4 million, exactly. So you invest $4 million into the firm. What do you do with this money? Does it stay there? No. You start buying equipment, machinery, maybe cars, maybe a truck to deliver, and so on. So that $4 million buys something we call assets of the company. All of these things, equipment, land, a factory building, and so on. It buys assets. Or if you're a retail shop, the biggest part of your assets will be, let's say you're Ahmed's grocery shop, right? You sell oil and bread and so on. Most of the assets are called inventory because you buy it and you resell it, right? You buy it at a lower price, sell it at a higher price. That's what we talk about raising money from investors. And the second part is how firms earn, okay, a profit, right? So this money, $4 million, buys assets, as we said. If we're a factory making objects, toys, right? We have to buy equipment, robots for making toys, raw materials, plastics, and so on. So that is how do you invest the money to earn a profit. And then as you start accumulating profit, what do you do with that profit? You could keep it in the firm and buy new factories, maybe in another country, buy distribution networks, whatever. Or you could give it back to the investors and stay at a constant level, and the operation stays constant, and all the profit goes to investors. So all of those are financial management decisions, what to do with that money. Is that clear so far? Okay, great. So in order to connect finance to the real market, we need to understand the overall economic circle, or cycle, we call it, okay? How many of you have seen this economic cycle? This is something that you study in basic economics when you start, okay? So it looks complicated, but actually it's not, and it's all very intuitive. So the easiest thing is to start back when there are no companies, no firms at all, thousands of years ago, right? There were always households. A household is a family, right? So we start with the simplest thing, which is a household. Father, mother, 3 children, let's say. What do the households have to give? Well, the households might own a piece of land, right? Land. They might own money, right? That's what we call capital. They might have $1 million. Let's say this is a household, they have $1 million, and they say, well, what are we going to do with all this money? This is great money. So they have capital, but also very importantly, they have labor. They have the power of their hands to till the soil, right, the land, or to manufacture something, and more important, of course, the power of the brain. So here, we call it labor in general, but it means everything that a human being can offer in order to produce in this world, in our economy, okay? So the households have this, and what do? They go into something that we call the markets for factors of production. So labor, land, and capital we call factors of production in economics. What is this market? This market is an abstract concept. It's not like the shuk, right? It could be on the computers. Let's say I am an accountant and I don't have a job, but I want to find a job. I go on the computer and look at job offers for various companies. That is the factors of production. Or I have a piece of land and I want either to sell it or to rent it, right? If you rent a piece of land, you get back rental income. So you go to a broker, a simsar, right, for land, and they say, okay, I'd like to rent this land, and I want a good income. So I have all that in the markets for factors of production. So from the markets for factors of production, all this goes to firms, right? So what happens? Labor, land, and capital for a firm are called inputs for production. And once the firm gets those inputs, writes a contract for land, for labor, whatever, they will give wages. So wages is for what? For which factor of production? Labor, exactly. Rent is for which factor of production? Land. And profit is for capital. Profit or interest again, right? Again, think of the Western world where you have interest, also is there. Finally, what happens okay, let's go back to the household. So they give this labor, and the wages, rent, and profit for the household becomes income, okay? And what do they do with this income? They spend it for goods and services which are bought in the market for goods and services. This is much easier it's like a shuk, right? Could be on the internet, could be anywhere. But it is a market for goods and services. So as they buy it, they generate revenue. Revenue is the income for the firms. We call it revenue. The income for households we usually don't call revenue. We just call income. But for firms, we call it revenue. But they have to pay, right? So the revenue comes in, and for that, they sell what? Goods, cars, and so on, and services. Haircuts, banking services, and so on, right? So the revenue comes in, wages, rent, and profit go out, and what remains, the difference between revenue and stuff that they have to spend, is what? Profit, exactly, okay? So this is how the economy, the real economy, relates to what the firms do and to finance. Now, when you think about the economy, Colin Clark, many years ago, came up with 3 terms that stick today. So when people talk about the economy, they always talk about these 3 sectors. The agriculture sector, which is, potatoes and animals and corn and so on. Industry, which is producing things. And services, right? Which could be retail, just selling stuff that others produce, or advisory. More and more services are of the advisory nature. Computer advisory services, internet building, websites, and millions of people in the world work in financial services, right? So those are all services. So now, within services, we narrow it down to financial services. So this is the area of finance concerned with the design and delivery. Design, you design something, a product. For example, a mortgage, which is a loan for a house. Or you design another product, a bond, we'll talk about that later, or a stock, right? So all of this design and delivery of both advice and various services to individuals, businesses, and governments. So these are the 3 recipients. Individuals, you hear many times about Swiss private banking or even private banking here in Saudi Arabia. Those are mostly to individuals or rich families, okay? For businesses, obviously, there are loans which are given to businesses, advice about how a business can get more money. After these 4 partners put in money and the business develops, they might need more money. So they might go to a bank to get money from them, Or they might go to new investors. In the public domain, they say, okay, we're going to issue stock and we get 1,000 new investors, each giving us $1,000, okay? So all that is advice to businesses and many times to governments, because governments sell and buy businesses in many countries, nationalize or denationalize, privatize. So financial services are to governments as well. And these financial services happen, of course, in banking. That's the major part where you can get financial services. But also there are many small firms which give personal financial planning. In many countries, there are family firms, maybe 10, 15 people, and they have maybe 100 families who need financial advice. So these firms do that. Another area, very important area, is investments. Let's say you have a pension fund. The pension fund of a company like Glaxo Wellcome, right, which has a subsidiary here in Saudi Arabia. This is very important, that tens of billions of dollars in GlaxoSmithKline's pension plan. And how do you invest that? How much do you put in stocks, in bonds, in real estate? All of that is done by investment management firms, which can be independent or part of banks, right? So investment is a very, very important part, and millions of people throughout the world work in managing investments. Then a smaller part, but still very important, is real estate and, of course, the insurance market. Trillions of dollars in the world are with insurance companies, which also need to invest it. So many insurance companies use investment managers to invest their assets. So now let's go even more deeply inside and see managerial finance, okay? It's concerned with the duties of the financial manager working in a business, right? So now we really work, and the business, again, when you work in a manufacturing business, let's take the example, let's say that these people are manufacturing toys, special toys, environmentally friendly toys. They need to know everything that we'll talk about during the next 2 days. But also you can think about a bank as a business which needs to make money, to make a profit, right? So in general, we think of businesses as manufacturing or service businesses, but also all of these businesses which serve other businesses are businesses themselves, which many need financial advice. Now, the financial managers themselves administer the financial affairs of all of these businesses. And we should not forget that there are private businesses, the majority, but also public businesses, right? Government-owned companies. And governments themselves need treasury. You know, the US Treasury, that's part of the government. The central bank is part of the government, essentially. So these are very important public services, large, small, profit-seeking, and not for profit, okay? Does everybody know what a not-for-profit organization is? Right, it's a charity. So even though they don't make any profit, they need to manage their finances. So you could be a financial manager in a charity like Oxfam. Oxfam is a very famous global charity which deals with poor people, you know, how to feed them, how to clothe them, or Save the Children is another. It's very deeply involved now in Syria. In Syria, people are starving, so this organization, Save the Children, tries to save starving children in various Syrian towns where children, you know, thousands and children are starving because Hezbollah and others don't allow food to go in. So all of these charities are very important, and people that I know that I've taught over the past 30 years have been very happy after working 5-10 years in a for-profit organization to go and show their expertise and use their expertise for not-for-profit organizations. So what are the tasks? The tasks are developing a financial plan or budget. Any company needs to look at the future. Short-term future, maybe 1 year, long-term future, 5 years. So the financial manager is deeply involved with forecasting how much revenue you'll get, how much costs, how many people you have to hire, how much raw material you will buy. All of that is called financial plan or budget. Also, a company needs to extend credit to customers because most customers, except in a small retail store, most customers don't pay immediately as they get. For example, if you make luxury yachts, many times you sell the yacht, they start using it, but they might pay maybe 20% today, 20% in 6 months, 20% in 1 year, okay? That means that you extend credit. That means credit means to believe, to trust somebody. So it essentially says, I'm trusting that I give you this car and that you will pay me in 1 year or 2 years, right? So extended credit is very important because you don't want to extend credit to customers which have a high probability of default. Default meaning they will not pay. They leave the country and you forget about it. So that's very important. Another important part is when you want to invest, let's say GlaxoSmithKline, which started in the UK, in the United Kingdom, wants to buy a company in Japan, a small pharmaceutical company in Japan. That is a large expenditure because it might cost 50 million British pounds, right? So financial managers are very closely involved in that. And then, of course, raising money, going to investors or to banks to finance the company's operations, to buy this new company or other things. So, typical titles that you will see of career opportunities is the entry usually is financial analyst. So when people finish university or business school, they start many times as a financial analyst. So the financial analyst could do all kinds of things. They could try to forecast things like what will happen in the economy in the next year, 2 years. And those are called financial plans, right? Plans and budgets. Also, you perform all kinds of analysis using Excel or using, in general, these days you use much more sophisticated accounting and finance software. Like many of your companies might use Oracle or SAP software, right? Okay, so a lot of this is done, actually, can be done on that software. Then you have the expenditure manager, the manager who deals with what do we need to spend and how do we need to spend it, which projects, big projects, small projects, and so on. So that is the capital expenditure manager. Then you have project finance manager. That's some of the activities overlap with the capital expenditure, but is much larger because you deal much more with external sources of financing, with lawyers, with advisors, with banks, with other companies. So project finance tends to be much broader and more complex, but many capital expenditure managers learn enough to become project finance managers. Then you go below, like much lower. You have the cash manager. Each big company has a cash management department. What do you do with the cash? Cash comes in, you might not need it for another 2 months. What do you do during those 2 months? You might invest it in government, treasury securities, you might invest it in other things. So the cash manager needs to deal with short-term assets, which are cash, and we call it also marketable securities. Marketable securities are the securities that can be sold it's like cash. So you can sell it in 1 second and become cash, right? Marketable securities are very close to cash. And always think about treasury instruments. Treasury bills in the United States, you lend money to the government for, say, 3 months, and you get it back in 3 months with a little bit of profit on it. Okay? So that's what you have to think about marketable securities. Yeah? Marketable securities. We'll talk about it a lot later. Right. Just remember the term, marketable securities. Okay, and so on. You can go over this and read it yourself and just kind of think about, what you might want to do if you want to work in finance, ever. Another way to look at it is the difference between real sector and financial sector. Again, the real sector is the first chart. Economy, products, services. The financial sector is that portion of the economy where financial assets are traded, not physical assets or services, but financial assets. The two major types of financial assets are stocks and bonds. How many of you don't know at all what a stock is? Okay, so all of you have a little bit of understanding of stocks, right? How about bonds? Okay, so I will have 2 short videos which go to the absolute basics of stocks and bonds so that everybody is at the level where they have an idea what stocks and bonds are. So we'll start with stocks.
Bonds are one of the most common investments. However, to many investors, they remain a mystery. So let's explore what a bond is and how it could benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors who, in return, are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Investors use bonds to preserve the money they have while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are commonly used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview will pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest payments continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, although returns are typically greater, profits and losses are driven by market forces and are considerably less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends on the financial stability of the issuer. For example, most governments are considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies, such as Moody's and Standard & Poor's, assign rankings to different bonds. This allows bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk, so it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate, so be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up and any bonds you own will be worth less if sold before their maturity date. After all, when interest rates rise, more investors allocate their money into new, higher interest rate bonds. If you want to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. So what role can bonds play in a diversified portfolio? For many investors, bonds are a way to preserve capital and generate income. Investors often use a mix of stocks and bonds to achieve investment goals, and because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors use bonds. Like all investments, bonds are complex and have a variety of uses. Before you invest in bonds, it's important that you invest in your own financial education. Take control of your financial future today.
Any questions on the stocks? Okay, it's pretty clear, right? Great. So bonds is a little bit more complicated because it again has to do with interest, with coupon, which is not in Islamic finance, but is very important. So bonds are a little bit more complicated. So if you have questions, don't hesitate to ask, okay?
What is the stock exchange and how does it work? The stock exchange is nothing more than a giant, globally networked and organized marketplace where every day huge sums of money are moved back and forth. In total, over 60 trillion euros a year are traded, more than the value of all goods and services of the entire world economy. However, it's not apples or second-hand toothbrushes that are traded on this marketplace, but predominantly securities. Securities are rights to assets mostly in the form of shares. A share stands for a share in a company. But why are shares traded at all? Well, first and foremost, the value of a share relates to the company behind it. If you think of the value of the company in terms of a pizza, the bigger the overall size of the pizza, the bigger every piece is. If, for example, Facebook is able to greatly increase its profits with a new business model, the size of the company's pizza will also increase, and as a result, so will the value of its shares. This is of course great for the shareholders. A share which perhaps used to be worth 38 euros could now be worth a whole 50 euros. When it's sold, this represents a profit of 12 euros per share. But what does Facebook gain from this? The company can raise funds by selling the shares and invest or expand its business. Facebook, for example, has earned $16 billion from its listing on the stock exchange. The trading of shares, though, is frequently a game of chance. No one can say which company will perform well and which will not. If a company has a good reputation, investors will back it. A company with a poor reputation or poor performance will have difficulty selling its shares. Unlike a normal market in which goods can be touched and taken home, on the stock exchange only virtual goods are available. They appear in the form of share prices and tables on monitors. Such share prices can rise or fall within seconds. Shareholders therefore have to act quickly in order not to miss an opportunity. Even a simple rumor can result in the demand for a share falling fast, regardless of the real value of the company. Of course, the opposite is also possible. If a particularly large number of people buy weak shares because they see, for example, great potential behind an idea, their value will rise as a result. In particular, young companies can benefit from this. Even though their sales might be falling, they can generate cash by placing their shares. In the best-case scenario, this will result in their idea being turned into reality. In the worst-case scenario, this will result in a speculative bubble with nothing more than hot air. And, as in the case with bubbles, at some point they will burst. The value of Germany's biggest 30 companies is summarized in what's known as the DAX share index. The DAX curve shows how well or poorly these major companies, and thereby the economy as a whole, are performing at the present time. Stock exchanges in other countries also have their own indices, and all of these markets together create a globally networked marketplace.
Okay, so any questions on the bonds? Yes?
The maturity is every year we take the...
Okay, good question. Maturity means when the bank, let's say you get a loan, right? You're an investor and you go to this baseball, whatever company, Fairview, and you say that I want my money in 5 years. I pay $1,000 now, and you will pay it back in 5 years. But then every year, you pay $50, 5%. So maturity is 5 years, when the principal, the $1,000, has to be paid back. Coupon is every year, 50, 50, 50. Okay? So that's maturity. Not every year is maturity. Maturity is only at the end. Most bonds give you 50, 50, 50 every year. At the maturity, they give you back the money.
The maturity, they give you everything.
They give you. Sometimes they accumulate the coupon and they give you $1,250 at maturity. But to keep things simple, most bonds, 90% of bonds, pay the coupon every year. Many American bonds pay the coupon every 6 months. Every 6 months, 2.5%, which means 5% a year. Okay? The big difference between stocks and bonds, as a stock owner, you own part of the company. As a bondholder, you don't own anything. You cannot tell anybody in the company how to manage their company. But as a stockholders, like these people, these 4 partners, they own stock. So, what do these, let's say they invest $4 million here, and they issue to themselves 1 million shares, okay, of stock. Then each share is worth $4, right? So just like here, they are owners of the company, they issue 1,000 shares, and it's $4 per share, okay? Another market that we will not spend a lot of time on at all, because we won't deal it in this course, is the foreign exchange market. But it turns out the foreign exchange market is the biggest market in the world. So stock transactions, there may be a few $1 trillion a day. Bond transactions may be hundreds of billions, but foreign exchange transaction is huge. Sometimes 8 trillion a day. I mean, they're just incredibly high volume. Exchanging real against dollars, dollars against Japanese yen, and so on. So you should be just aware of the foreign exchange market, because financial managers in each company have to deal with that, especially multinational corporations. They need to know, I'm getting, like GlaxoSmithKline, I have my operation in Saudi Arabia. I have to forecast what will happen to the real. What should I do? Keep it in real, turn it into US dollars. Like many managers now believe that because there's a huge risk in 2016, the dollar is strengthening because a lot of people put money in the dollar, and a bit less because there's not so much volume into the Swiss franc. So we see the Swiss franc strengthening, the US dollar strengthening. So it's a very, very important decision for financial managers what to do with foreign currency. If you're interested, again, you can just go to YouTube and find out more about the foreign exchange. market. Another area where financial managers are really called for are what we call foreign direct investments. You see, as a Saudi, I can buy stocks in the US stock exchange, stocks of IBM or Microsoft or Apple Computer, right? But also, Saudi companies can buy other companies or shares in other companies. Let's say an investor likes this company and wants to buy part of it. That we call foreign direct investment. They buy 20%, 30%. If a company or an individual from one country buys part of a company in another country, a big chunk, not just 0.1%. Like if you buy IBM, you buy maybe 1,000 shares, and you have a tiny ownership of the company. Foreign direct investment usually is a big ownership of the company. Okay, there is a controversy that you might hear, is how important is the financial sector? Some people say it's really much less important than the real sector. Other people say it's just as important, even if maybe it's even more important. In my opinion, I think they're 50-50. Both are very important. One could really not live with the other. So if you meet this controversy, think about it, because everybody has a different opinion. So maybe at some point you'll have to make up your own opinion. But in my opinion, the financial sector has such a great influence on the real sector, partly through psychology. What do I mean by that? Let's assume that the stock market is going down. Just now, the world is very worried because China is slowing down and the Chinese stock market is crashing every day, 6-7%. But because of that, the American stock market is crashing too, and the European stock markets are crashing too. And I see just friends around me who say, I don't know what will happen to my investments. I'm not going to buy that car. I plan to buy a car in January 2016, but I'm really worried about the financial market. I'm not going to buy that car. So if tens and tens of thousands of families, of households say, I'm not going to buy a new car, I can keep my old car for another year, strong influence on the real economy, right? You can even have a recession. So it's really important to understand the interaction. So now let's go even deeper. We go into the company, right, that you're very comfortable and familiar with, because all of you work, I assume, in all kinds of companies. So just a reminder for many of you, what is the corporate organization in general, right? You start with the stockholders. Think of IBM, there are tens of thousands of stockholders, big stockholders, small stockholders. Who are the stockholders? Individuals, families, pension funds, insurance companies, and so on. So all kinds of stockholders, we call them individual and institutional stockholders. Now the stockholders elect a board of directors, which are partly inside board members like the CEO, the chief executive officer, president of the company, maybe a few other officers, but also external people who own stock in the company but who do not work in the company. So very important is the board of directors. The board of directors hires the president, who, as I said, then can become part of the board of directors. So the owners hire the managers, and the president then usually hires the top executives, which in many companies are called vice presidents, right? Human resources, manufacturing, whatever. And very importantly, you have the vice president of finance, okay? And in general, in most companies, the vice president of finance hires the treasurer and the controller. There are two big functions within managerial finance in a corporation. So what does the treasurer deal with? Then he hires the smaller managers. You have the credit manager, which makes sure that people or companies that we sell our product to will be able to pay us back in 2 months, 3 months, right? We have the foreign exchange manager, which now you know how important it is. You have the financial planning, and many times they also do the fundraising, right? They say, well, we need to buy these raw materials, but we don't have enough cash, so I need to go to a bank and raise some money to buy the raw material, okay? So that's the financial planning. And then you have the cash manager who has to deal with the cash. As we said, what do we do with this cash? Do we invest in a treasury bond, right, for 3 months? Do we invest it maybe in a short-term bond issued by a big company? We call that commercial paper. We'll talk about it later. And then you have the pension fund managers in many companies. We talked about that, okay? So all of these are under treasury. Then you have the controller. And the controller Very important task is financial accounting manager. The financial accounting manager deals a lot with external entities because they issue the annual reports of the company. In the United States, they have to issue it every quarter, a statement about the assets, the liabilities. We'll get into that in detail. But it's very important, and that's usually under the controller. Then you have the cost accounting manager. How do you put cost to products? And you want to make sure that the revenue is higher than the cost to make a profit, right? All of you who work in companies know what that means. Then you have the tax manager, right? When you have to pay taxes to the city, the state. In Switzerland, you pay taxes to the town that you're in, to the canton, which is kind of a small little, like a little state, and to the federal government in Bern. All those taxes are dealt with this tax manager, okay? So these are the key functions in a large corporation. In a smaller corporation, maybe the credit manager and the cash manager are the same person, right? Or depends. But in all large corporations, you have all of these guys. Now, once inside the company, the top managers, together with the board of directors, need to come to a conclusion that satisfies all of the owners. And that is, what is the goal of the firm? Now, in traditional capitalism, which the key representative is the United States, but also Britain, to a less extent Germany, but let's talk about the Anglo-Saxon countries, US, UK, Australia, Canada, and so on. The goal is simply to maximize the shareholder wealth. So if I invest in a company, I give the money to the company, I expect the share to go up and up and up. And everybody in the company should just make me happy, make the share go up. That is the traditional goal of the typical capitalist company, is to maximize the shareholder value. So as a financial manager, if we work in one of these companies, American companies, what do? You always have to make decisions, financial decisions. Do we invest in a new factory? Do we invest in Japan? Do we invest in Somalia? Whatever. And when you look at these alternatives, what do we do with our money? What do we invest? You have to look at two aspects, very important. Return. What do we mean by return? Can somebody tell me what is return? Return on investment, exactly. So that's what we talk about, right. So when people talk about return, is return on investment, and we'll talk about it much more. But just to give you an example, return on investment, ROI, right? So for these people, these partners, if after they start this company, they make a profit of $400,000 a year, every year, the return on investment is $400,000 divided by 4 million. Okay, 4 million, so it's 10%. Okay, that's how we calculate return on investment. But not just return on investment, not just return, but risk. Because if we can get 10% by investing in Afghanistan, it's not the same as getting 10% investing in Switzerland, right? The risk is much higher in Afghanistan. But let's say somebody comes to the investment manager and says, we can invest in Afghanistan and get 30% return. Or invest in Switzerland and get 5% return. That's not an easy decision. So the financial manager has to analyze in depth the risk in Afghanistan versus the risk in Switzerland and say, is it worth? We know the risk is higher in Afghanistan, much higher, but I can get 30%. So they have to weigh those things, both return and risks, and to try to analyze how will the share price go up or down. Let's say a company in Saudi Arabia decides to invest in Afghanistan. And many investors say, oh my God, Afghanistan is a big mess, and the share price goes down because people don't want to deal with a company which invests a lot of money in Afghanistan, right? So the financial managers needs to think what will happen, even if they believe that the risk is high but the return is really high, how will that affect the share price? Now, some managers say, well, in the short term, the share price will go down, but then they will see that we invest in Afghanistan and we get this incredible returns of 30%, then the share price will go higher and higher and higher later. That's fine if really it's very well documented. But the financial manager has to think short term and long term, how to make these decisions, okay? So the decision theoretically is simple. If it increases the share price, you accept this project. If it doesn't, you reject it. Okay, means increasing the shareholder wealth or maximize the shareholder wealth. In many countries, especially Scandinavia, but Germany and other European countries, people deal a lot, and more in the US, by the way, as well, with stakeholders, not just the shareholders, right? But stakeholders, which are groups which are employees, customers, cities or towns where your company is located, public pressure groups, not-for-profit organizations like the World Wildlife Fund, and so on. All these are stakeholders because they all are interested in what happens to the company. And sometimes maximizing shareholder wealth goes against the interest of some stakeholders. Let's say that I believe I can maximize my share by firing 20% of my employees because there is a recession, okay? So maybe the shareholders will be happy about that, but the employees will be very unhappy. So there's a strong push in Scandinavian countries, in Germany, that is not as important to maximize shareholder wealth as to balance, not to make too unhappy the employees, or maybe in some countries like India, in the past, but less and less now, Western companies would go and pollute, right? Because they say we can produce this product cheaper in India, the share price will go up, but the stakeholders, which are the populations in the towns, would suffer, and those obviously are stakeholders. So more and more companies deal with a balance between various stakeholders, and the shareholders are the most important, but not the only one. So you must make, and this view is called socially responsible, right? To take into account the environment, to take into account the people, to make sure you don't have children working for you, child labor. All that is very important these days. So we call it a stakeholder focus, in contrast to purely shareholder focus. And the key part of this is business ethics. This is not a business ethics course, but more and more in business schools across the world, in the United States, at Stanford, where I went for my MBA, at Harvard, at London Business School, and so on, business ethics is taught, and it's very important because it's strongly related to stakeholder interests, how to make sure that nobody is hindered in their happiness, right? So you have to make compromises, and ethics is about good practices, things that you should do without harming people, right, too much. So again, ethics is very, very important. Good. We talked about economics, right? The cycle, products, services, and so on, and the financial cycle. So it's very important to understand that finance is closely related to economics. Now, unfortunately, you will not have an economics course here, right? So we'll have to deal just with those key parts of economics that impact strongly on finance. One of the easiest things to understand in economics is the law of demand. How many of you know what the law of demand is? Yes, okay, so you know. So the law of demand essentially says that if I increase the price, the demand will go down. So financial managers have to think carefully what price they will charge. Because if they charge a high price, maybe the volume that they sell is lower. If they charge a low price, the volume will be higher. So they have to find an optimum where the revenue is maximized, which is the price times the volume. Okay, so that's an important economic thing. But another very important one is the so-called marginal cost benefit analysis. And we'll get an example, okay? Is the economic principle states that financial decisions should be made and actions taken when the marginal or added benefits exceed the marginal or added costs. In this analysis, which is somewhat different from what most people do, you have to take everything into account. How much revenue, how much cost, old versus new, and so on. So here's a very simple example. Let's say a company decides to have their sales force use a new computer, which is much more powerful than the old computer. And they calculate that the benefits per month, okay, or the benefits over whatever period is $10,000 per salesperson, okay? Now with the old computer, the benefits were $3,000. So clearly the benefits are much higher with the new computer. So when we talk about the marginal benefits, it's simply this minus this. So that's what you have to look at, the additional benefits, not just 10,000. It says, great, 10,000, brilliant. No, you have to look at 7,000 because that's really what is relevant here. Because you could just keep your old computer and still have 3,000. So the marginal benefits are 7,000. Now let's look at the costs, right? Marginal costs. You have to think about that you can actually sell the old computer and you get money from the old computer. So if you sell the old computer, okay, first of all, the cost of the new computer is 8,000, right? That is very easy, you just take money. But don't forget that you can sell the old computer for $2,000. So proceeds means money coming in. Proceeds means what comes in. So again, the marginal cost is not 8,000. You would think, oh, I have to spend 8,000 on the computer, that's my cost. No, the marginal cost is 6,000, right? And then the net benefit is the marginal benefit, 7,000, minus 6,000, which is 1,000, okay? Because if you just say, well, the benefit is 10,000, the cost is 8,000, so great, I have a benefit of 2,000. That's not how you think about it. Economically, you only have a benefit of 1,000. That's the key thing to focus on, okay? Another example is, let's say you hire a new salesperson and say this salesperson can bring me $100,000 worth of business in a month, but I have to pay him $70,000, right? There it's much easier. The marginal cost is 70,000 and the marginal revenue is 100,000. So 100,000 minus 70,000 is 30,000, okay? So, but if you think, just do an exercise in your head. Let's say that you replace an old salesperson with a new salesperson. The old salesperson only brought in 80,000, but you paid him 60,000. The new salesperson will bring you 100,000, but you have to pay him more, right? So you have to compare really the marginal benefits versus the marginal cost, okay? So that's one example. So that's all we'll talk about economics, okay? Because we just don't have time. But we'll talk hours and hours about, very important, the relationship to accounting, okay? Because without accounting, you simply cannot do finance. So the finance and accounting activities are closely related and generally overlap. A finance manager needs to know accounting very well, although a purely accounting guy doesn't need to know finance nearly as well as the finance manager needs to know accounting. Now, in small firms, accountants often carry out the finance function. Why? Because you just don't have enough funds. If you have a family business with maybe 10 employees, you have one person who might do marketing and finance and accounting and so on, everything together. In a large company, the functions are quite separated, as we know. Now, a big difference in perspective and emphasis between finance and accounting is the keyword accrual method, right? So write that down because that's very important. In accounting, you use the accrual method. Whereas in finance, you focus much more on cash flows. And one of our skills that we'll develop in this class is to how to go from accrual accounting to cash flow accounting, okay? So you could say, let's say my firm has a profit. I'm very happy with it. But when a finance manager comes in, you say, but your cash goes lower and lower and lower, and you'll go bankrupt. You say you have a profit, but you don't have any cash. Is that possible? Yes, that is possible, very much. So that's why we need to understand the difference between accrual accounting. We look at profits, and you could be happy with that. But when you look at the cash part, you might be happy or not happy with that. So here's a typical, simple example. You are a company which makes luxury yachts, or not so luxury, 100,000 is not luxury, it's a small yacht. And you sail. Sales or revenues are the same thing, right? When you make a contract, I make a contract to sell a yacht to this particular person. You record immediately in your book, right? The accounting book, say sales revenue, 100,000. And costs, 80,000. So profit is revenue minus cost, right? So 100,000 minus 80,000. Now, the person who bought the yacht will not pay you right away. It will pay you in a few months, which means you extend credit to the buyer. But the supplier of the yacht wants the money right now from you, okay? So you pay the cash immediately out, but you receive the cash much later from the yacht owner. So what happens? Here is the accounting view as we talk the accrual basis. The sales revenue is 100,000, less cost 8,000, so net profit is 20,000, right? Say, well, I'm profitable, that's a very nice profit. On the cash basis, what is the cash inflow today? 0, right? But the cash outflow is 80,000, so the net cash flow is 80,000. So you need to have that cash actually to pay, and you have to wait 2 months, 3 months, whatever, to get the money in, okay? So any questions on this simple example? Because this is very important to understand the accrual view versus the cash view. This? So you write a contract. I am going to sell this yacht to this customer today. Okay, you write the contract, and that immediately, as soon as you write the contract and the customer signs it, you record a revenue of 100,000 in your books, on your spreadsheet, wherever. So that's what you say. I'm recording sales revenue of 100,000, and as soon as you record the revenue, you also have to record the costs associated with that revenue. So you record 80,000 and say the profit is 20,000. But because you don't have any cash inflow today, and you have to pay today 80,000, the cash outflow is 80,000, right? So the net cash flow is negative. The profit is positive, the net cash flow is negative because you had to pay out. Positive cash flow would mean coming in today. Now, maybe in 3 months, if he pays you, then you have a positive cash flow coming in. Okay, we'll see how to deal with that later. Now, in personal finance, you always use cash flow view. Okay, you don't use accrual view. So it's very simple. Let's say this month, my salary was $4,400, net pay received, and this is the outflow. I had to pay all of this. Rent, car payments, whatever, okay? But I also, because I have some bonds, I received interest income. So you add it up. So the total inflow of cash is this much. This is the total outflow, and the net cash flow is negative. What does that mean? It means that this person has to go to the bank and get money from its savings to cover this cash flow, right? So personal finance is much easier in many ways. Okay, another difference, this is a key difference, accrual, but another difference in terms of the job characteristics. Accountants devote most of their time to collect and present data. They collect the data and they present it to potential shareholders, potential investors, banks, and so on who need to know about this data. Whereas financial managers, they evaluate the accounting statements of their company over the past year, 2 years. Many times they compare the financial statements of their company with that of their competitors, other companies which compete, and using all this data, you have to make financial decisions, investing, buying, selling, and so on. So it's much more challenging intellectually to be a financial manager than to be an accounting person or accounting manager.